Welcome to the third lecture of week 4. In this lecture, we are going to discuss about the economics of non-renewable resources as well as the economics of fossil fuel as a part of energy supply. We begin with the economics of non-renewable resources. The main question that we ask in the context of non-renewable resources is today or tomorrow. If you look at coal, oil, natural gas, this kind of fossil fuels, they have a finite stock, which means if you take it out today, some X amount, and consume it, and in order to carry out the economic and other activities, it essentially means that this particular X amount will not be available for tomorrow's use. Therefore, if you use it today, it will not be available tomorrow. And therefore, we start with the question whether to extract and use it today or to extract and use it tomorrow. The market prices of these non-renewable resources, other than reflecting the cost of exploration and production, therefore also reflect something which is called a depletion premium or a scarcity rent. Now let us spend a couple of minutes to understand what is depletion premium or scarcity rent. So as we are saying that there is a finite stock of these resources. So if I use it today, it will not be available for tomorrow. So I am using it today at the cost of tomorrow. Or if I want to postpone my consumption, in that case, I am using it tomorrow at the cost of today. So there is a trade-off between today and tomorrow, and this actually leads to a concept which is called the depletion premium or scarcity rent. This says that if I keep on consuming more and more these non-renewable resources today, I'll be left with less amount tomorrow. Therefore, it will create a scarcity of this kind of resources. If there is a scarcity of resource, then the price is going to go up. Therefore, what we are trying to say here is that the market price of these non-renewable resources, they not only reflect the cost, but it also reflects this kind of depletion premium. What is rent? In the economic literature, you will see this word very frequently. So basically, rent is defined as a payment to the owner of land or any other property to allow access. So when you are saying about the scarcity rent, as if you are paying a rent because you are using this non-renewable energy today and at the cost of tomorrow. So that is the concept of scarcity rent. If you go into in deeper of the literature of non-renewable resources, you will come across this concept of scarcity rent over and over again. And this kind of, determines the path of depletion and the price of non-renewable resources in the market. So as I have said, today's use of resources supports the activities, right? And therefore it generates some kind of utility today. But if I'm extracting and using it today, then my tomorrow's activities will going to go down, and therefore it's going to affect tomorrow's utility. So there is basically a trade-off between today's utility and tomorrow's utility. If I extract and consume more today, my today's utility will be more. However, if I postpone my consumption and use it tomorrow, my tomorrow's utility is going to go up. Therefore, if you think about in the context of a consumer behavior framework that we discussed when we were discussing about the demand for energy, you saw that the consumer is trying to trying to come to an equilibrium where she is deciding how much of Q1 she wants to use or consume and how much Q2 she wants to consume. Here the problem is also the same. Here the consumer or the economy is trying to decide how much resources are to be extracted tomorrow and how much resources are to be extracted today. If I extract today, my today's utility is going to go up. If I extract it tomorrow, my tomorrow's utility is going to go up, but at the cost of the other. Let us try to develop some kind of a theoretical model. This is a very basic fundamental theoretical model, and there are a lot of advancements on this, but we are just exploring what is the beginning. So suppose the utility function of the economy, or you can think about the consumer, is denoted as U is equal to U of Q1 and Q2. What is this Q1? Q1 is basically the present consumption of the non-renewable resources, and Q2 is the future consumption of non-renewable resources. Now, utility is a function of both present consumption as well as future consumption. We also define a term called marginal utility, which denotes the gain in utility as you consume one additional unit of some commodity. So here we are defining the small u1, which is del u1 q1 del q1, and small u2, which is del u2 q2 by del q2. So small u1 is the marginal utility that you are deriving from the consumption of the non-renewable resources today, and u2 is the marginal utility that you are deriving from the non-renewable resources tomorrow. Now, one thing here I would like to mention that this marginal utility in the context of economic framework, how we kind of conceptualize marginal utility. Let me give you an example. Suppose you are very thirsty, so you need water to drink. The utility that you derive from the first glass of water is very, very high. Once you get the first glass of water, you would still like to get the second glass of water probably, but the utility that you derive from the second glass of water is going to be less than the first glass of water because you already had the first glass of water. So as you keep on consuming one particular good or service or any resources, your marginal utility tends to fall. Okay, so we will assume that both small u1, which is the marginal utility that you are deriving out of the consumption of non-renewable resources today, and u2, which is the marginal utility that you are deriving out of the consumption of non-renewable resources tomorrow, both are falling as you increase q1 and q2 respectively. Now remember, behind what is the intention behind developing this kind of a framework? The intention is to divide the finite stock of resources in two parts: the part that you are going to extract and use today, and the part that you are going to extract and use tomorrow. So here, instead of thinking about today and tomorrow, that is only two period of time, you can also think about some n period of time. So that will give you a continuous framework when you are dealing with multiple period of time. But for the sake of simplicity, here what we are doing, we are taking only two periods of time. But you can develop the same model and framework for multiple period of time. In fact, that is mostly what is available in the literature, but we are starting with the most basic one. Before we go to the theory of resource depletion, theory of resource extraction in case of the depletable resources, let us have a quick recap at the consumer equilibrium. So the equilibrium of the consumer is attained at the point where the slope of the budget line, that is the slope of this RN line, is equal to the slope of the indifference curve, that is at point E. Now at point E, the slope of the budget line is equal to slope of the margin, the slope of the budget line is equal to the slope of the indifference curve, or what we can say is the absolute slope of the indifference curve is equal to the absolute slope of budget line. Now we know that the absolute slope of the budget line is given by the price ratio P1 by P2, and the absolute slope of the indifference curve is given by the marginal rate of substitution, which is U1 by U2. Therefore, at point E, what we basically have is U1 by U2 is equal to P1 by P2. Or what you can say, this U1 is basically the marginal utility derived from Q1, and U2 is the marginal utility derived from Q2. So the ratio of the marginal utilities is equal to the price ratio. Now, one note of caution at this point is that if you look at the latest consumer behavior theory, the theory of ordinal utility theory, it's not mandatory that the marginal utilities are declining. It is mandatory that the marginal rate of substitution actually declines as you increase consumption of one particular commodity. But here what we are assuming that the marginal utilities are also declining, and the ratio of the marginal utilities are actually equal to the ratio of prices. In this framework, the Q1, if you think about Q1 as the present consumption of the non-renewable resources, and you think about Q2 as the future consumption of non-renewable resources. So you are likely to get a similar kind of equilibrium if you want to decide how much to use today and how much to use tomorrow. So what we are going to do, we are replacing the concept of, we are just having the concept of Q1 and Q2 in a more specific manner. Instead of saying Q1 is one particular commodity and Q2 is some other commodity, what we are saying here is Q1 is the present consumption of the depletable or non-renewable resource, and Q2 is the future consumption of the same non-renewable resource. And the price that is invoking in the present period is P1, and the price that is invoking in the future period in P2. However, in the future slides, we are going to see that the equilibrium is not exactly the same, but it can be, derived from this kind of a notion. Now let us come back to this today or tomorrow question. So how much do we use today and how much do we keep for tomorrow's consumption? So this vertical axis, two vertical axes, they are going to measure the marginal utility. On the left hand side vertical axis, we will measure the utility derived from the present consumption, and in the right hand side, we are going to plot the utility that is derived from future consumption. The horizontal line, the length of the horizontal line represents the amount of resource that is available. So remember, this is not actually reserve, but the total amount of resource that is available in case of this depletable resources. Or you can say this is the total stock of the resource. So this is this length. How are we measuring the present consumption and future consumption? The present consumption is measured from left to right, and the future consumption is measured from right to left. So where the present and future consumption meets, that point actually gives us the division between the present use and the future use of the non-renewable resource. As we have said that the marginal utility declines as the consumption of resources increases. This is true both in the context of today as well as in the context of tomorrow. So if we plot the marginal utility curve that we are deriving from the consumption of these non-renewable resources, look like this. So as I said, in the left axis, I am plotting U1, that is the marginal utility that I am deriving from the consumption of the depletable resources today, or today's consumption of depletable resources. And on the right hand side, I am plotting the marginal utility that I am deriving from tomorrow's consumption. So this is how the marginal utility curves look like, and both of them, they are falling. So here if you look at this line is falling as the present consumption is increasing. On the other hand, the small U2 line is also falling as your future consumption is increasing. Now coming to the next question. How does it give us a hint about the division of the resources between today and tomorrow? See, if I am a point somewhere like this, if I choose point D, choosing point D means I am actually using this part for present consumption up to D from my left, and I am keeping this part, this up to D from my right for the future consumption. Then what is the specification of this point? At this point, you see what is happening. U1 is greater than U2. That is, the marginal utility that you are deriving from today's consumption is higher than the marginal utility that you would have derived from the future consumption. If this is the case, if we are at a point where U1 is greater than U2, in that case, if you increase the consumption of today, that is, if you increase today's consumption and leave less for tomorrow, then what happens? Then you move to a point like C. So CD is actually your increase in today's consumption, and this is the decline in your future consumption. Then what happens? As you move on from D to C, your present consumption is increasing. What is the increase in your utility? Your utility, the total utility, is increasing by the amount A, B, C, D. So this area of A, B, C, D actually represents the integration under the curve U1 between the 2 points C and D. So as you increase your present consumption from D to C, your total utility is going to increase by the amount A, B, C, D. However, you also have to notice that this is not the only thing that is happening. Increasing your present consumption means that you are actually reducing your future consumption. So, what is the amount of reduction in your future consumption? That too is DC. And what is the reduction in your total utility? The reduction in your total utility will be the area under the curve U2 between D and C. So the loss in your utility because of reduction in future consumption is denoted by EBCD, this area. So what is the gain in your utility? So you are gaining something, gaining in terms of utility because you are increasing your present consumption, and you are losing in terms of utility because you are reducing your future consumption. However, this diagram shows that in this kind of a situation, if U1 is greater than U2, that is the marginal utility of Q1 is greater than the marginal utility of Q2, in that case, it's probably a wise decision to increase the consumption of the present. Because as you move on from D to C, your net increase in utility is captured by the area ABE. So what you see, you increase your present consumption from D to C. As a result, your utility increases by A, B, C, D. However, this leads to a reduction in consumption for the future by the amount DC. As a result, your reduction in utility is EBCD, which leads to a net gain of utility of the amount ABE. So this shows that if your marginal utility from today's consumption is greater than the marginal utility of tomorrow's consumption, then it's better to increase today's consumption and reduce tomorrow's consumption. In the similar way, you can see that if today's consumption is such that U1 is less than U2, then it's probably a wise decision to move to point B. So you decrease your present consumption and you increase your future consumption. So whether you are to the left of this point B or to the right of this point B, the tendency should be to come to point B where you have marginal utility of Q1 is equal to marginal utility of Q2. So the marginal utility that you are deriving out of the consumption at the present period is equal to the marginal utility that you are deriving from the future consumption. So if B is the point, then from the left to C is your present consumption, and from right to C will be your future consumption. However, this is more or less the guiding principle, but this is exactly not what happens, and therefore I have said that the optimum is likely to be achieved at U1 equal to U2. But in a moment we'll see we need to do a little modification in order to come to the optimum allocation of this resource over 2 period of time. Why it is not the case that U1 equal to U2 will guide you to take the optimal decision? The reason is as follows. You can go back to the concept of present value and future value. Usually, what we discussed under this present value and future value is that usually we prefer today's consumption as compared to tomorrow's consumption. What does that mean? Again, if I take you back to the example of a 100 rupees note that I have, if I have it today and I put it in the bank and I earn a rate of interest of 5% per annum, then at the end of the year, the money that I have is 105 rupees. So today's 100 rupees is equal to tomorrow's 105 rupees. So the present value of the money that I have is 100 rupees, whereas the future value of the money that I have is 105 rupees. Instead of that, if I have 100 rupees only in the next year, so that future value of that money is 100 rupees and the present value of the money is going to be less than 100 rupees. So here the same thing is happening. U1 is defined in the context of today and U2 is defined in the context of tomorrow. But we cannot compare U1 and U2 or the consumption of the same resources today and tomorrow as a one-to-one basis. because today's consumption is likely to give me more utility as compared to tomorrow's consumption. This is what is called the rate of time preference. Okay, so rate of time preference, or it is also called the rate of discounting, at the rate at which you prefer today's consumption as compared to tomorrow's consumption. I'll just quickly give you the I'll come here, I'll quickly give you the formula for the present value and future value that we had a discussion on. So you see the present value is equal to future value divided by 1 plus g to the power t. So the g was the rate of growth, okay, and the t of the time period that you were considering. Here we don't have any issue, our t is equal to 1 because we have the time period 0 and 1 only, okay. The g is actually equivalent to your rate of time preference, the rate at which your preference is growing or your preference is falling with respect to the consumption. This is usually denoted as R, but it plays the same role as G. So if we have to compare, today's marginal utility and tomorrow's marginal utility, I have to take into consideration the rate of time preference. So the present value of today's marginal utility is given by U1. There is no issue with that. However, when we say U2, this is the future value of tomorrow's consumption. Future value, right? So U2 is basically the marginal utility that I am deriving in future. If I want to calculate the present value of this marginal utility of future, I have to divide it by 1 plus R. See, this T is becoming 1 and the G is becoming R. So what I am saying, the present value of U2 is equal to U2 divided by 1 plus R to the power 1. So the present value of U2 is given by U2 divided by 1 plus R. So the optimum is not really achieved at this point where U1 is equal to U2, but rather the optimum is achieved at a point where U1 equal to U2 by 1 plus R. So the present value of future marginal utility is equal to today's marginal utility. How do we denote that in our diagram? So instead of this particular, this red line, this continuous red line or this solid red line, we derive another line which is the. Now how do I incorporate the same in the diagram that we have? So instead of going by the line, this line, so this line U2, we will actually construct a new line which will denote U2 by 1 plus R. So you see what is happening, this U2 is rotating as it is divided by a factor 1 plus R. So instead of going by this point, we are now looking for the intersection between U1 and U2 by 1 plus R. So the new equilibrium that we are saying will give the optimum result is at this point. So this point, this interaction between the red broken line representing U2 by 1 plus R and the solid line of U1, this actually gives you the point of optimality, or this actually tells you how the resource needs to be divided between today and tomorrow. So if this is the point of equality between U1 and U2 by 1 plus R, this is this Q1 amount. Now I am measuring it from the left hand side. This Q1 amount is what you can extract and use today, and the Q2 amount, which is measured from the right, should be extracted and used tomorrow, so that the present value of the marginal utility of both the periods actually remain the same. We are left with one more question. What is the price that needs to be charged for these two periods? Now see, we have discussed about the resource rent. So there is a scarcity rent that one needs to pay. As the resource becomes more and more scarce, this means that the price should go up. Now this price should go up even if the cost of extraction and production remains unchanged, and that is the scarcity rent that we are talking about. That is again determined by the concept of the rate of time preference or the discount rate. So the proportion in which the price should increase in future as the scarcity increases is actually determined by the rate of time preference or the R that we have been discussing. How is that happening? If you go back to your consumer behavior, we said that the equilibrium takes place where the indifference curve is tangential to the budget line. So that is your U1 by U2 is equal to P1 by P2. Or what I can write, U2 by U1 is equal to P2 by P1. Now we have already seen that U2 by U1 is equal to 1 plus R. R is your rate of time preference. So what I can write here is that U2 by U1 is equal to P2 by P1 in case of market determined price, which is equal to 1 plus R, R being the rate of time preference. Now if you look at this, the construction here, the distance between these two lines, this red line representing U2 and the red broken line representing U2 by 1 by R, what does that do? You take this, if you take at this point, this distance BK, this is actually reducing U2 by a factor of 1 plus R. So if I have a point at K and if I multiply it by 1 plus R, I'll get the point B. If I at point A, I multiply it by 1 plus R, I should be at point B. So this distance BK is actually representing the factor 1, the multiplicative factor 1 plus R here. So now how do we determine the price? Again coming back here, if I say U2 by U1 is equal to P2 by P1 is equal to 1 plus R, then doing a little bit of manipulation, what we are getting is that, see, P2 by P1 is equal to 1 plus R, which means R is equal to P2 by P1 minus 1, which is P2 minus P1 divided by P1 is equal to R. Now what is this P2 minus P1 divided by R? This is the rate at which the price is growing from today to tomorrow. So again remember, we are talking about 2 time points. So this is the annual growth rate. This also we discussed when we were discussing about the demand. So the growth rate in price is equal to your rate of time preference. So the rate at which you prefer today's consumption as compared to tomorrow's consumption determines your rate of time preference, that determines your discount rate, and that again determines the rate at which price is going to increase in future in case of non-renewable resources. Now how do I point out P1 and P2 in this diagram? So clearly this point K, this denotes the intersection between U1 and U2 by 1 plus R. So this is the point of equilibrium, and Q1 is the amount of quantity of non-renewable resources supplied and used tomorrow. So the price today, Q1 is the quantity of non-renewable resources supplied and used today, not tomorrow. So the price that the market is going to charge today will be at P1. So this is the price charged and this is the quantity consumed. This is determined by this U1 curve. However, what is the price that is going to be charged tomorrow? See, tomorrow's price, it's going to grow up at the rate R. So tomorrow's price, that is P2, is nothing but 1 plus R P1. So if I need to multiply P1 by 1 plus R, I end up with a price which is P2. Because you remember this BK, this is actually giving you the factor 1 plus R. So I multiply P1 by 1 plus R in order to get P2. So the rate at which price increases is equal to the rate of time preference. Now instead of making it a two period analysis, you can also make it a multi-period analysis, and you will actually get a step diagram here where you will see P1 is less than P2, which is again less than some P3, and so on as you move on in the time. So this explains why the price of depletable resources on the non-renewable resources increases over time. Now this increase, remember, is not due to increase in the exploration or increase in the production. This is simply reflecting the rate of time preference and therefore the scarcity rent that you are paying in terms of price. So this R, the rate at which it is increasing, is captured by Hotelin in his 1931 work. This is often called the Hotelin's R or Hotelin's rule, in which by which you can explain the pathway of resource extraction in case of non-renewable resources, and can also identify the optimal price path. If you are interested, you can go back to Hotelin's writing. This is yet even today it's very, very relevant, and often this theory is used in the context of the non-renewable resources and to explain its depletion and the resource rent and the price. We're going to stop here with respect to the depletion perspective or the depletion perspective of the non-renewable resources. And what we are going to move on is to the economics of fossil fuel. Here we are going to talk very briefly about exploration, field development and the production. Especially we will focus on the cost aspect. So we are not going to go into the deep of all these notions, but we are simply going to understand them uh, a little bit, so that if you are interested and if you want to gather more knowledge about in future, you have a starting point. So starting with the cost of exploration. So that is the first stage of the production of fossil fuel. So what is exploration? The objective of the exploration is to identify the stock of fossil fuel and to add it to the reserve. Now here you see there are two things that we are talking about. One is a stock of resource and the other is the reserve. Now stock of resource is not equal to the stock to the reserve. What is the stock of resource? This is the entire amount which is available, right? Which is available. It may be explored, it may not be explored. It doesn't matter, the whole stock, it is a stock of resource. So the stock, the amount of resource which is available is actually unknown to us. But what is known to us is that through exploration activities, whatever has been confirmed, whatever availability of this resource has been confirmed, that is called the reserve. So reserve is something where exploration activity has led to identification of the stock of resource. Now we are talking about the cost of exploration. The cost of exploration, any project which is related to this, the extraction or exploration or extraction or production of this fossil fuel, it's a very cost incentive process. So if you before, as I said, there are three stages. The first one is exploration, the second one is extraction, and the third one is production. Even before you go on for the exploration, there are a lot of things one needs to do. It includes the pre-exploration survey and studies. It also includes the cost of drilling and then the cost of rentals and so on. So there is a large amount of money that is involved if you think about the exploration activity with respect to the fossil fuel. And what is the nature of this cost? See, at the initial phases, when the reserve is established, so when the the result of the exploration activity is positive, and suppose you have found out the oil well and you want to drill it, at the initial phase, it's easier to take take this fossil fuel out. So at the initial stage of exploration, it shows faster addition to the reserve. However, as time goes on, then it becomes difficult to add to the reserve and it becomes more costly. So you can compare it with the groundwater, right? As keep on taking the groundwater out, initially it's very easy. You have a water table, you can take the water from a shallow depth. However, as you keep on taking out this groundwater, you have to keep on moving to deeper and deeper, and therefore the cost of extracting the groundwater will increase. The same thing happens in the context of fossil fuel. Initially it's not very costly, it's relatively easy to add it to the reserve. However, as you move on, as you are going for the higher volume of and the increase in exploration activities, the marginal cost is going to increase. So for one the additional cost you need for exploration is going to go up. It leads to this kind of a marginal cost curve for the exploration activities. So you can see up to this point it's quite low, the marginal cost of exploration. However, as the exploration goes up, the cost is going to go up, and after a point it's going to be very, very steep. So maybe beyond this point it's not very economical to take up the activity of exploration. So when we think about the fossil fuel, the one part is the geological availability, whether fossil fuel is available or not, how much is it available. But the second important part, because it is very, very cost intensive, the second important part is whether it is economically feasible to take that fossil fuel out or not. So the decision that you need to take is whether to invest or not to invest in exploration activities. If you can recall, when we discussed about the investment criteria in previous week, we spoke about the concept of net present value. We also spoke about the concept of annual rate of annual return and so on. Here we are going to make use of these kind of concepts. So how do I decide whether I should invest or should I not? Why this is a very crucial decision? Because as I have said that the capital cost is very high in the if you want to go for exploration activities. Now it doesn't mean that the variable cost is low. The variable cost is also very high. However, the capital cost is higher, and there is an element of uncertainty associated with that. Why the element of uncertainty? Because even if I go for an exploration activity, there is no guarantee that I am going to find out the fossil fuel. It may result in an unsuccessful story where you spend a lot of money, however you do not find out the fossil fuel that you are looking for, and this happens quite often. This is not a rare story. So the decision making actually involves a cost benefit analysis based on a probabilistic model, and where you calculate something called the expected monetary value of the project. Now what do we understand by the probabilistic model? So here I am not saying that there is one net present value of a particular project, and just looking at the net present value I am going to take a decision on whether to invest or not to invest. There can be multiple net present values associated with different probabilities, and therefore I have to come up with the expected monetary value of the project. This will be clearer if we go by this kind of, and this is a small exercise with few numbers where we can look at it. Before that, a quick recap about the net present value. So this was the formula of net present value, where we said that RT by 1 plus I to the power t, this is the present value of the revenue stream. Ct by 1 plus I to the power t summed over t, this is the present value of the cost stream. And I is the investment, which is already in terms of present value. So this is the present value of the net revenue that you are generating during the lifetime of the project. So this is the NPV, and we are going to make use of this concept, so it should be clear to you. So let us now have a look at this table. What we are trying to do, it's like a decision tree. So I have to take the decision in favor of or against drilling. Either I drill or I do not, either I invest in drilling or I do not invest in drilling. If I drill at a particular area, the probability of success, that is the probability that I find out some fossil fuel, say 0.25. So the probability is low. The probability of failure is relatively high. Say the probability is 0.75. Now what does that mean? If I success, now I am going to one step further and moving to the conditional probability, where I am saying that even if I succeed to find out the fossil fuel, the net present value that I am going to derive out of the project is not something which is confirmed. So I can have a net present value. The project can derive a net present value what of 100. This is again in some suitable units, maybe crores of rupees. Is net present value is 100 with a probability which is low, 0.25. So I'll get a small net present value is low, which is 0.25. The probability that I'll get a decent net present value, that is 200, is 0.5, and the probability that I'm going to get a very high net present value, that is 500, is again 0.25. If I look at this 6 numbers, what I am getting is the probability distribution of the net present value. What is the probability distribution? It's the probability that I get the net present value equal to 100 is 0.25. Probability that I get NPV equal to 200 is 0.5, and the probability that I get NPV, which is very high, and 500 is 0.25. So in a sense, what is the expected NPV? The expected NPV is 100 multiplied by 0.25 plus 200 multiplied by 0.5 plus 500 multiplied by 0.25. However, if you look at this number is not actually representing 100 multiplied by 0.25. What is this? This is 100 multiplied by 0.25 multiplied by 0.25. Because see, when I am talking about the expected value, expected net present value, this is contingent upon the fact that there is a success. So if I take into account that conditional probability into my calculation, the amount that the net value, the expected net value that I am going to get is actually 100 multiplied by 25 multiplied by 25, which is 6.25, plus 200 multiplied by 50 multiplied by 0.25, which is 25. Again 500 multiplied by 0.25 multiplied by 0.25, which is 31.25. So the expected net present value is actually arising out of a conditional probability, which is 6.25 plus 25 plus 31.25. However, if I come back to the probability of failure, which here is very high, 0.75 is the probability of failure. If the project fails, then the net present value is going to be negative. So you see the revenue that I am generating is going to be much less than the cost and the investment, present value of the cost and investment. So the NPV is negative. Now, if NPV is negative, there is only one option. I don't have multiple, or I don't have a probability distribution of negative NPV per se, because this is only one event which is happening with a chance of occurrence of 0.75. So, what is the expected loss if the project fails? That is minus 50 multiplied by 0.75, which is minus 37.5. Now, how do I take a decision? So, if I add up 6.25, 25 and 31.25, what I am getting is the net expected present value or expected net present value. This is my expected gain. What is my expected loss? My expected loss is minus 37.5. So, what is the expected monetary value of the project? This is the expected value of NPV minus expected loss. So this is 6 plus 0.25 plus 25 plus 31.25 minus 37.5, which is 25. Now in this case, what we see that the expected value of money, which is equal to 25, is positive. So your expected gain is actually greater than your expected loss. If you get the expected value of money to be positive, then it's wise to take the decision in favor of investment. However, it's not the only criteria, but this is the first step where you begin with. Now, in this context, if you think about this EVM, this is expected value of money, it still is associated a lot of uncertainty and risk, and therefore comes the role of the government, especially given the fact that the government owns all these resources, and you need a permission if you want to explore and extract this kind of resources. So next point is field development. Once the exploration activity is done, the next is field development. That is, you develop the field in order to extract the natural resource. Once the presence of the reserve is guaranteed, then only you go for this field development for extraction. Now, if the result of exploration is positive, that does not necessarily mean that you have an idea about how much fossil fuel is available on the ground. What you know that fossil fuel is available there, but the exact amount is again unknown to you. So even in the case of field development, at the stage of field development, there are certain uncertainties involved. The cost of field development is again very, very high. This includes the field site development and all kind of operating costs. So the whole business of exploration and extraction and production of fossil fuel based energy is very, very high. Depending on the economic feasibility and geographical certainty or uncertainty, the resources can be classified in the following manner. So under the economic feasibility, there are two categories. One is economically recoverable. So the reserve that you have can be recovered economically so that you have some profit. The other can be uneconomical. So in case of uneconomical reserve, the reserve is there in place. So the result of the exploration activity is positive. However, it's not economically feasible to take that resource out of the ground. In case of geological uncertainty, there are two classifications are possible. One, the resource which is identified, and the resource which is undiscovered or to be discovered yet. If a resource is identified, then it can be proven. So in case of proven, it says I know what is the amount of resource available. So I not only know that the resource is available, I also know the amount of resources available. And the other is inferred. So here what we are doing is that we say that, okay, we can understand that resource is available there. However, we are not very sure about the amount of resource which is available there. So if a particular reserve or if a particular stock of non-renewable or this fossil fuel has a proven and sort of it's proven that it is there, and it is also possible to recover it economically, then it is called a reserve. So reserve, when we use the term reserve, it usually has two characteristics. One, you have a proven reserve, and the second is it's economically viable to recover that reserve. However, there can be other economically viable recoverable reserve which is inferred, and that is called the inferred reserve. But interesting thing is that even if there are proven reserve or inferred reserve, it may happen that it's not economically feasible to take these things out. So these uneconomical reserve are called demonstrated sub-economic reserve if they are proven, and inferred sub-economic reserve if they are uninferred. And in case of undiscovered reserve, or in this case of undiscovered stock, I would say some of them are hypothetical and some of them are speculative. However, in future we may see that the undiscovered reserve may be economically recoverable or it may not be economically recoverable. Now, one interesting thing is that these classifications are not very hard. I mean, they are not written on the stone. Why is it so? Because see, it's the economic feasibility which is actually putting a line here between economically recoverable and uneconomic. If there is, with the advancement of technology, if the recovery becomes less costly, it becomes more efficient, then some of the reserves which are now identified as demonstrated sub-economic reserve may come into the category of reserve, which can be economically recoverable. Also, the technological progress actually shifts the line between identified and undiscovered reserve. So, with the technological advancement, it's possible that you go for more sophisticated exploration techniques and therefore you identify more and more reserve. So, this is the soft category that is available. However, the boundary between these categories are kind of flexible in terms of economic availability, that the technology and so on. The final stage is production. The production follows more or less the similar pattern as we have seen in the case of the other production and supply behavior of the producer. If I just have a quick look at here, this is the quantity that is being produced and this is the cost associated with this. You had this average fixed cost. So fixed cost is the amount of money that you need to put in irrespective of the level of activity. And we have been discussing so far that the level of fixed cost is very, very high in case of exploration, extraction and production. So the average fixed cost also, which is represented by this rectangular hyperbola, is very high in case of the production of the non-fossil fuel based resources. The second is the average variable cost. And the third here is the average cost, which is an aggregation of average fixed cost and average variable cost. And here we have the marginal cost curve. So this is the addition in cost as you increase your production by 1 unit. And we have already discussed that marginal cost is determined only by the variable cost. The fixed cost has no role to play in the context of supply in a sense. So this is what we have said, that the production of fossil fuel is capital intensive and that is reflected in very high fixed cost as compared to variable cost. However, this is not to say that the variable cost is low. So this is one thing we need to understand. Now, since the variable cost is low, I should have written, relatively low, the producer tends to operate at full capacity and supply more. So for capacity, development of the capacity, you have put a lot of money. As compared to that, the production cost is less. So you want to utilize the full capacity. Otherwise, your investment will lie idle. So what the producers will try to do in case of fossil fuel, they will try to produce as much as possible to go to their full capacity utilization, as long as the variable cost is recovered. So it cannot go into a situation where the variable cost is not being recovered. Recall the concept of shutdown point here. So we said the shutdown point is the minimum point of the average variable cost where the marginal cost cuts the average variable cost from below. Now was it called a shutdown point? Suppose this is the price that the market is paying to the producer. This is the price of the fossil fuel. And the equilibrium, profit maximizing equilibrium from this producer will be generated where this price is equal to marginal cost. So this point, this minimum point of ABC here in this context is giving the equilibrium point for the producer. Now how much is the producer producing and supplying? It's producing this much. Now what is happening here? You see here this P multiplied by Q, this rectangular area is giving you the revenue. Okay. And this area also is giving you the total average variable cost. So you are recovering through your revenue, you are recovering just your average variable cost. As long as you do that, you keep on producing. However, if the price falls below this, then what happens? Then your revenue, total revenue is less than the total variable cost. Therefore, you are not being able to pay the variable inputs and you have to stop your production. So in case of fossil fuel as well, the producer and the supplier just keeps on producing as long as it can recover the variable cost that it is incurring. Now what is the role of average fixed cost? It is often considered as a sunk cost. So something that has already been there and you're not going to take this into consideration when you are talking about the economic cost or the economic decision making. The last part that we are going to discuss is the resource rent. Now what is a rent? We have already said that the resource rent is basically a payment to the owner of a land or the property to allow access. Now what kind of rent do we see in the context of energy? We have already discussed one kind of rent, which is the the depletion rent or the scarcity rent or depletion premium. So that is, we are not going to bring that into this literature. This is more sort of a rent that that accrues to a producer because it has certain advantages with respect to the production of fossil fuel. So keep the scarcity rent in your mind, but we are not going to include it here because that is something what was used in order to decide over the price. So there are four types of rents: the mining rent, technological rent, positional rent, and the quality rent. We'll come back to them one by one. But before that, let us focus a little bit on this diagram. So this is again in the price quantity space. This is where I'm plotting the quantity and this is where I'm plotting the price. And what you see, this is the supply curve. So supply curve essentially is the upward rising part of the marginal cost curve that you have. And suppose this is the market demand curve. So the equilibrium is determined at this point of intersection between supply curve and demand curve. Q star is the quantity produced and P star is the price charge. Now you see what is happening. If you take any quantity, for example this quantity, call it Q prime or something, then if you look at the supply curve, what does the supply curve say? The supply curve says if the producer has to supply this much of fossil fuel or produce this much of fossil fuel, you have to give the producer at least this amount of money to recover his costs. Okay, so this is the willingness to accept. This is the minimum willingness to accept for a producer. If you pay the producer below this amount, then the producer will not produce, because in that case the producer is unable to recover the cost. However, you see the market price is actually higher than the cost that is incurred by the producer. This difference between the market price and the cost that the producer is incurring is called the rent. So for this particular producer, there is a positive rent which will accrue if the production is here. Okay, so why is it happening? This may happen. Why do you think that the price that the market is paying is much higher than the cost that a producer is actually facing? This may arise because of different rents. What are these rents? Mining rent. This arises due to difference in the geographical or geological condition. For example, in case of oil and gas, the operation is easier and less expensive in the flat desert in the area. However, for oil, there is one particular price, right? So there are not differential prices for differential producers. There is one market price. However, if you are operating in a location which is, in a flat area, your marginal cost is going to go down and your rent component is going to be higher. There can be technological rent as well. If you are using more advanced technology, then it's expected that your marginal cost is going to be lower and the rent that you are getting is higher. Similar is the positional rent. If the well has a proximity to the market, that reduces the transport cost and it also gives access to certain kind of information and other amenities. And the final one is the quality rent. For example, the light crude oil actually fetches a higher premium or higher market price as compared to heavy crude oil, although the supply curve or the cost curve may be quite similar. So here we see at every point of production, if this is the supply curve, at every point of production, there is one component which covers the cost of the supplier, and there is another component which gives the supplier something more over and above the cost, which we are calling as the rent. If I integrate this whole part of rent, this rectangular area, this is called producer's surplus. So this is producer surplus. Why? Because this is what the producer, if the producer is supplying at Q star, this blue triangular area is the amount that the producer is getting over and above the cost that the producer is incurring. So this is sort of a concept of producer surplus. More the producer surplus, more will be the benefit accruing to the producer. Now, what the government does? Where does the role of government comes? It actually follows the concept of this producer surplus. Why? See, when we think about the fossil fuel, the state is the owner of the underground resources. So if you want to extract and produce fossil fuel based energy, basically you have to sign a contract with the state where you get the land on lease and then you carry on your exploration activities and so on. So there has to be a contract. What does the contract do? It actually talks about sharing of two things. One is the sharing of risk and other is the sharing of profit. So if the government is actually willing to share both risk and profit, then you can see more and more private investors will come and invest in fossil fuel industry. However, if the government actually tries to, sort of share the profit in terms of taking the rent back, but does not share the risk, then it is less likely to have higher investment. So let us look at the mechanism how the government actually implements a tax or royalty in order to get a profit sharing. Because you remember the underground resources, they are actually owned by the government. So I am actually asking for some rent because I am giving that you in some contract. So once this once this tax or the royalty is imposed, then for per unit of production, the supplier has to pay something to the government. As a result, if you think about the cost of the supplier, there is an increase in the per unit cost of the supplier. And the supply curve of this fossil fuel supplier moves from here to here. So it goes up, which means that if you still want to continue with Q star amount of production, your marginal cost has gone up. However, if the demand curve, remains unchanged, then you no longer stick to the old equilibrium. Your equilibrium shifts, and now you are producing less Q prime, which is less than Q star, and the price that you are asking from the market is higher, which is P prime. So your new equilibrium is P prime, Q prime, higher price and lower quantity supplied. Now see, if you look at the distance between the new supply curve and old supply curve, this is the amount of money charged by the government as a royalty per unit of production. So if your production is Q prime, then the total money that is going to the government in the form of royalty is represented by this blue box. So this is the distance between the new supply curve and the old supply curve multiplied by the new quantity that the supplier is supplying in the market at equilibrium. So this is how the government can take a royalty or take a part of the profit or take a part of the producer surplus to the government account. Now, this is a very simple model that we are talking about, and here the underlying assumption is that the market is competitive. However, in most of the cases, you will see that the market for fossil fuel is not at all competitive. It's either monopolistic in nature, the monopoly can be the state monopoly as well, or in some cases, this is oligopolistic as nature. So, the nature of rent and royalty and how it applies, everything is going to change as the market setup or the market framework changes. But this is the beginning. If you are interested, you can always go back to the textbook and study more about this. We are going to stop here. Next week, we'll come up with some new topics for discussion. Thank you.